And joining us from the CME Group, John Brady, Senior Vice President, MF Global. John trades fixed income futures and treasuries. And also with us is Doug Cliggott, U.S. equity strategist at Credit Suisse. He has a fair value target of 1,100 for the S&P and sees no reason to change it. Doug, why is that?
Well, Matt, I think, lately the data flow's been really poor. I mean, we've just got a relentless flow of economic information saying we're slowing down, we're slowing down. There's a positive, though, and the positive you were mentioning earlier, large companies have very good balance sheets, a very high level of profitability, and many of them are paying out very attractive dividend yields. So we think we're in this trading range here, but the quality of large corporations, we think, puts a floor under the market.
Hey, no trading range for you, John, in the fixed income market. I mean, treasuries have just been soaring. Do you see that stopping here? I mean, do you run out of steam at some point in this kind of rally?
Well, we have had quite a move from about 3% to 2.5% in the course of the last 4 to 5 weeks in 10-year Treasury yields. And it's tough to see tremendous gains from here. If anything, I think the market environment probably favors some type of consolidation trade before a renewed leg lower. Much of short-term performance out of 10-year Treasuries will depend on Dr. Bernanke's comments tomorrow morning. And there is a case to be made that Dr. Bernanke will, in fact, try and push some of the levers of physical stimulus onto Congress. Monetary policy cannot fix all the ailments that currently weigh down the economy, and thus perhaps getting Congress more involved with more physical stimulus may be one way to help alleviate the strain upon the Fed, and that, of course, will dictate the direction of 10-year Treasury yields as regards tax cuts, deficits, and Treasury issuance.
Hey, what do you think, Doug, about Congress? I mean, does it play into your investment thesis? What happens in November? Does it stay the same?
I think, Matt, this is a tough call. To think that we can have a more stimulative fiscal policy, I think it's a real tough call. Right now, if you look at taxes as a share of GDP, they're below 15%. Long-term average is 18%, so I don't see how we can cut taxes. I think, we're kind of frozen on fiscal policy now.
I have a few ideas on how they could cut taxes, but I will save those for later. Let's get back to John and Doug. And Doug was talking about the low tax revenues we're seeing as a percentage of GDP and how he can't imagine where we would cut. I want to ask you, John, and as I pull up your profile, I notice you have a bachelor's degree in business administration, one in political science, and one in history, a master's in accounting, a master's in finance, and a master's in international relations. What have you learned to help us in this conversation? I mean, do you think that if we raise taxes, we'll raise tax revenue? If we cut taxes, do we maybe spur growth? What's your take on this?
Two comments, Matt. First and foremost, I think that we talk about tax revenues being a very small percentage of GDP right now, and Doug is exactly right. The problem is that monetary policy can't really go much lower than where it is now, between 0 and 25%. So I think that Dr. Bernanke, I think the odds are somewhat high that he's going to reach out to Congress and say that the Fed needs to work in partnership with the executive and legislative branches in order to get this economy going. And that may include a payroll holiday tax for some sort of time period, may include the extension of the Bush tax cuts. But at some point, monetary policy is not going to be able to solve the problems that currently ail the economy. Overcapacity, call it what you may. My second point is, you are nice to bring up my academic background. My parents would suggest to you that their return on investment has been rather poor. But what I would stick to the main point, and that is perhaps some type of tax holiday. I think we're going to continue to see an intensification of deflationary pressures, which may take 10-year yields to 2%. But at that type of level, we could see federal stimulus, executive branch and legislative branch driven stimulus come in to try and reflate the economy, because monetary policy has little to nowhere to go.
Doug, one of the other points that I would perhaps make is that if you look at the earnings that have come out more recently, like a J.Crew, like a Cisco, for example, those numbers have not necessarily been as strong as the economy then perhaps starts to catch back up with these companies. Aren't you concerned that that's going to continue to happen for the rest of the year as the economy gets worse? Then we're going to start to see it in earnings.
We are not optimistic about earnings growing a lot from here. I think the run rate on operating earnings is roughly $80 a share right now. I think that's about where we're going to be for quite a while.
That would be hot.
You don't have to.
$80 a share would be hot.
You know, that's what the run rate was in the first half of the year, Matt. And I think, you know, with all the slowing of momentum we've seen, I'm not sure we move a lot above that. But you don't need too much of a multiple on $80 to, you know, say around where we are right now is okay. But this tax idea, I think the idea of doing something on payroll taxes is a fantastic idea. I just don't think you want to do it on a temporary basis. I mean, if I could float an idea, I'd say let's get rid of payroll taxes, bring down the cost of U.S. labor, but we need to substitute it with something because we can't have an overall net tax cut. So I think maybe putting in a value-added tax and getting rid of the payroll tax. At the end of the day, I'm not sure we can reduce taxes as a whole.
If you're going to put in a value-added tax, why not just take out the IRS completely? Because you can replace, according to fairtax.org, all income taxes with a value-added tax.
Well, you know, I think the highlight here, Matt, is we need to start thinking outside the box because monetary policy can't do much more. We really have to get creative in terms of policy ideas. We need to get jobs growing.
Hey, John, I want to bring you to this discussion here because there's a lot of ways that people can kind of play this market right now. I was having a conversation with Keith McCullough over at Hedgeye. He's got his asset allocation model, the majority plus in cash right now. Where are investors supposed to go in this environment if they're not supposed to go to stocks, if bonds are in a bubble? What are they supposed to do right now? Are bonds the best play right now, or do people look for dividend-paying stocks?
I think it's tough to find true value or cheapness in the bond market, given the run the bond market has had this year. And given the cloudy macroeconomic outlook, I would suggest that investors perhaps consider small mining stocks in gold and silver. And the reason being is that the macroeconomic outlook globally remains rather challenging and perhaps volatile. And a lot of that volatility tends to get translated through the foreign exchange markets. And whether it's a weaker euro currency, a stronger yen, a weaker dollar, or perhaps some type of fundamental change in the yuan eventually, I just tend to think that gold will be the beneficiary at the end of the day. And mining stocks, specifically small cap mining stocks with fixed expenses and fixed expense basis, probably have the most to gain in such a scenario.